Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Paniotu, certified financial planning professional, the Cap and Capitalize. In today's free financial tip of the week is, once you understand a business and invest with conviction, ignore the noise, even if everyone else disagrees. So this actually ties into today's interview, where I got to interview the legendary investor / financial author, Robert Hagstrom, who wrote The Warren Buffett Way, a New York Times bestseller. It was the 30th anniversary. And fun fact, he told me I was the first person he thought of when he was contacted by Wiley to go out and get interviewed by podcasts. And he's been on some pretty big ones. So not to toot my own horn, but according to Robert, I am the best. But I digress. Going back to the tip, Robert Hagstrom wrote in depth about how Warren Buffett, throughout his career, invested against the grain. When you think about it, in hindsight, of course, it doesn't look like against the grain because it's Warren Buffett who's the GOAT. But when it came down to it, it didn't matter what the world was saying. Warren Buffett's lost his step. He's too old. He's not getting into tech. Why is he investing in Wells Fargo when they've got all these bad loans coming due? Well, now you fast forward, he's got arguably the greatest investment track record of all time. So how does that relate to you regarding the free tip of the week? If you understand a business to the point where you understand it so well that when people are trying to nitpick at it, you go, it's almost that gut feeling. You know you've got something fantastic. So don't be afraid to invest against the grain. Someday you will be paid for it. Now, back to Robert Hagstrom, we got to dive into not only the Warren Buffett way, but we got to dive into a number of different things that I wanted to ask Robert that he's never been asked before. And that's really tough because Warren Buffett Way, this is I don't even know how many editions this was, but it's been out for 30 years. It was just deemed a Wiley classic, which Robert, huge congrats, buddy. That is fantastic. And so when I reread the book, I thought, you know what? This is the first year where Charlie Munger won't be around at the Berkshire Hathaway conference. And as this is coming out, this will be right before I fly out to meet everyone at Berkshire. And I wanted to see in Robert's mind some of the things Charlie would think about today's investment world. And then also, how do you value some of these businesses that, in my mind, are so egregiously overpriced? You think to yourself, can they really get more and more and more expensive? And you're going to be shocked at some of the stuff that Robert says today. So without further ado, because I could blabber on for hours, sit back, relax, and enjoy this educational and uberly entertaining interview with Robert Hagstrom. It's been 2 years since you've been on last, and I'm excited to celebrate the Warren Buffett Way's 30th anniversary. And this is going to be a little different of a show because, you know, I don't know about you, but I get so sick and tired of being asked the same questions all the time, every day. And there's a lot of things where, of course, I've read the Warren Buffett Way and the Warren Buffett portfolio. But I'm going to take a number of different avenues that I think are more pertinent for today and also the future. But, you know, with all that being said, I'm going to ask a question. I want to start off with one that I'm sure you've never been asked before. What was it first like meeting Warren Buffett?
Okay, so here's the first time I ever met Warren Buffett. Of course, I don't know if you know, I did not meet him prior to writing the book. I had never met him. When I was writing the book, and, you know, to back it up, you know, I don't know if you want to go to the very beginning or not. I don't know what your time limit is and what you want to talk about, and maybe you can edit out stuff. But
sure.
I wanted to be a writer. I had written in college and had written I went to Villanova University. I wrote for the school newspaper. I started the Libertarian Society at Villanova. I was interviewing congressmen and senators during the election cycles. And I had it in my mind I was going to go to Washington, D.C. and be the next, Woodward Bernstein and, light up the town. And got down there for 3 or 4 months and just hated it. I mean, there's no rationality there whatsoever. I came back and the local newspaper where I had done some writing, I asked them for a job and they said, we can't afford to pay you. But if you go out and sell quarter-page ads in the newspaper for us, after so many commission dollars, we'll let you write a column. So I walked up and down the main line, Lancaster Avenue, banging on doors, small shops, it didn't matter. And I, did this for days and came across something that said Legg Mason Wood Walker, members of the New York Stock Exchange. I had no idea what that meant. I thought it was a law firm or an accounting firm. I walked in and I said, I'm Robert Hagstrom, can I see the manager? They took me back. I said, hey, Robert Hagstrom, would you like to buy a quarter-page ad in the newspaper? And the branch manager said, no, would you like to be a stockbroker? I swear to God, it was 1983, the beginning of the great bull market. And they were looking for bodies and they were looking for salesmen. So I went into training, and after 3 weeks, I thought I'd made a terrible mistake. I was a liberal arts major. I hadn't taken any finance accounting. All they were doing was talking numbers, balance sheets, income statements, cash flow. I had no idea what they were talking about. And the night before we were going to conclude the training session, I had decided to resign. I was going to sheepishly say, I'm sorry I wasted your time, but this doesn't work. And our training instructor, wonderful woman by the name of Laura Lane, gave us a photocopy of the Berkshire Hathaway annual report, which I had never heard of, written by a guy named Warren Buffett, which I had never heard of. Said, read, come back the next day and discuss. And it was reading it that night that it was, it was the epiphany, right? The light bulb goes off because he began to talk not about numbers, but about companies and people and business and products. And so that's what resonated with me. And so in production, I was just a kid following a ball player, doing everything I could to learn about Warren Buffett, getting all the annual reports of Berkshire and the companies that he managed. And I was doing my business like, Warren was, buying and holding stocks. My manager at the time then came up and said, Robert, you're going to starve to death if you don't sell something one day. And I said, well, that's not how this works. We're supposed to buy and hold stocks. Yeah. Went to the buy side. Got my CFA, and in 1992, CFA Institute said if your performance is not 100% discretionary, you can't publish it, which meant, it had to be you and nobody else. Well, we were acting like a trust company, Chris. We had clients, if they had a favorite stock, we'd put it in there. If they had a tax issue, we would make changes in the portfolio, so it didn't qualify as discretionary. And I knew we were immediately in trouble. I said, we don't have a track record. We can't grow the business. And they said, what do you want to do? I said, well, let's do this Buffett thing. And they said, we're up to here with you and Warren Buffett. That's all you talk about. And they said, well, write a marketing piece on what you want to do. That marketing piece became the Warren Buffett Way. I sent him a letter saying, I'd like to use your copyrighted material in the annual report for my book. And, he didn't know me. I introduced myself. Weeks later, I got a letter back saying, Robert, I can't give you copyright permission just yet. Well, in sales, not just yet. It's not a no. It's just, what do we got to do to get this done? And the deal was that I had to send him every chapter, which I did. Debbie Bazanik was his secretary then, who's still his secretary to this day.
I know. And
she would call and say, you're doing fine, keep going. At the end, I got copyright permission. The book was a great success. I had never been to a Berkshire shareholder meeting, and the next fall, the book came in October, and the next year I reached out to Debbie and said, I know Warren goes to the Cap Cities ABC annual meeting in New York. I'm in Philadelphia. I'd love to come up and meet him, and she put it together. We're at the annual meeting. I'm sitting in the back, and we agreed to meet after the meeting, and he comes walking down the middle of the aisle, and I stand up frozen. And he reaches out his hand and says, Robert, I'm so glad to meet you. And that was the first time we met. We talked about 5 or 10 minutes. And he says, I expect you to be in Omaha this year. I'll see you at the Berkshire meeting. And I went to the Berkshire meeting that year and have gone every year since then. So it was a roundabout way that we got to know each other.
Yeah, what an awesome story. Well, and when I was thinking about you coming on, because I know everyone, especially this year, it's going to be yes, it's going to be Charlie Munger centric because obviously it's the first year that he's no longer with us. And then also the big questions are going to be swarming around, Charlie Munger's gone, but what's going to happen when Warren's gone? And I want to actually ask you a couple questions I've thought of that I would think are a little bit more profound in a positive light. And, you mentioned in the book that he's got three of the most prominent people in his life: Ben Graham, Phil Fisher, and Charlie Munger. And in no real order. And I've thought about this, and I'm curious, out of the three, if they were all alive today and able to invest for the next decade, who do you think would be the best outperformer and why?
Oh, it'd be Charlie. Because Charlie was pragmatic. Ben had the right methodology at the right time, and a lot of people probably forget, we write about this in the book, that Ben Graham was ruined twice in his lifetime. Once when he was a young kid, he had come over from Europe with his father, who I think was in his 30s, and his father died tragically young setting up a business. His mother had to raise him. They were penniless, and so he really lived hand to mouth for so many years, and that really had an impact on him. And then of course, as he became successful in investing, he lost it all again in the 29, well, it wasn't the 29 stock market crash, it was 1930 when he tiptoed back in thinking the crash was over, and he got his head handed to him. So, being financially ruined twice in his life had a big impact on his life, which was don't lose money, which is the cornerstone of value investing. So Graham was all about, I'm going to invest in the market to make money, but my first rule is don't lose. And that set up, buying low price earnings, low price to book, nets, and things like that. That's okay. But the way in which you make money over 5, 10, 15, 20 years is not buying a bunch of cheap stocks that aren't going down. It's trying to buy great businesses at fair prices that can compound at high rates of return over the next 10 years. And that was Charlie. I mean, if you read I know you read the annual report this year, in the first page, the tribute to Charlie, called him the architect and said, Charlie was the one that geared me to move on from Graham to kind of a Phil Fisher type role. But, Charlie had a phenomenal track record in the Munger partnership, and he made a ton of money. And he was the one that got BYD. He was the one that told Warren to get BYD and Costco, and think about his track record. I'd probably want to invest with Charlie of the three of them for sure.
And so obviously you mentioned there Graham basically versus Charlie. Charlie would take the cake. So what about Phil? Where does he fall in there?
Well, so if you think about Graham was the quantitative side, right? He was the numbers. He was by the numbers at a discount. He was very leery of people putting too much weight on management, too much weight on the quality of the business, because you couldn't measure that. It was kind of ephemeral, right? You couldn't really measure it. And those feelings about management or feelings about the business sometimes elevated the price up too high. And so he was always, I don't want to think about the business. I want to think about the management. I just want to know what the hard assets were. Well, Phil Fisher didn't spend so much time on the hard assets. He was talking about, what's his company like? Who's the management stuff? So he picked up on the fundamental side of what a good business is and what management is. And Graham was very much about the quantitative side. And Phil didn't spend a lot of time teaching us about valuation. And then ultimately in 1992, as you know, and he had already been practicing it, but in 1992 annual report, he finally said, look guys, it has nothing to do with PEs, high PE, low PE, price to book. It has everything to do about the dividend discount model. He introduced John Burr Williams. And now we know today, fundamentally speaking, that's the right way in which to think about valuation. So if you think about it, Graham was, the numbers guy. Phil Fisher was, what's a good management, good business. And John Burr Williams was, this is how you actually value a company over time. So it became kind of a mesh of all this that came together. So, just to back up, Warren said today the two takeaways from Ben Graham, reading all of Security Analysis, reading all of Intelligent Investor, the two things that are long-lasting about Ben Graham are Chapter 8 and Chapter 20, and the Intelligent Investor, Chapter 8, being about the margin of safety, which Warren says that's still the three right words. You buy things at a discount. And chapter 20, how to think about markets, the temperament of how to think about markets that are bouncing around all the time. So the two things that Warren takes to this day that Graham taught him were just this: buy assets for less than they're worth and have the right temperament when it comes to the volatility of the market. Nothing else. That's all that he's brought over from the Rubicon was margin of safety and temperament.
Well, and it's interesting because, he's got that famous quote, he meaning Warren, that I'm 15% Fisher and 85% Graham, although you said, and this was, I think, in your earlier versions, that you think it's more of a 50-50. I would almost say that that's totally flipped today due to the size of Berkshire and all that. And so could you argue by default that, Warren is almost all Fisher today? Because with the size of Berkshire Hathaway, how many nets are there out there that moves their needle?
No. Yeah, well, the 15% Fisher, 85% Graham was written in the 60s.
Right.
And this was before he bought See's Candy in 72. So, there wasn't much Fisher in his life in the 60s. It was still Graham. And he was still operating the Buffett partnership from 56 to 69 based upon Graham's low price earnings, low price to book. And, and you could just make money. It was raining money. That's all you had to do. Buy 3 multiples, 4 multiple stocks trading at a discount to book value. And it rained money, rained money. So I think he was aware of Fisher. He met Fisher, read Common Stocks, Uncommon Profits, went to California, met with him, sat down with him, found him to be like Graham, a great teacher, very generous in his intellectual capital. So I think he had Fisher in his mind when he said that. But clearly, by the time you get to See's Candies, boy, then you see Fisher just, burst onto the scene. But Charlie was already there, right? If you think about it, Charlie was already there before See's Candies. And he was saying to Warren, you bought this thing called Berkshire Hathaway. Don't ever buy another company like that ever again. But now that you have it, what you add to Berkshire Hathaway are better companies at fair prices. And let's get out of this racket of buying the cheapest stocks that don't have much economic vigor. Because, as you well know, Chris, if you're going to buy cheap stocks with poor economics, you better trade them. You've got to make a profit in the short-term trade, because if you buy and hold mediocrity, that's your economic return over time. So to buy Ben Graham and be successful, you've got to trade it. And I think Warren and Charlie both came to the conclusion, as Berkshire got bigger and bigger and bigger, to try to trade it constantly was going to be a loser's game, and they needed to figure out how to do the buy and hold. And, that was the Fisher. Fisher was a low turnover guy, too. He talked about that in Common Stocks and Uncommon Profits. So he was a compounder.
Yeah. Well, and I don't know if you've read Security Analysis by Ben Graham and David Dodd. Yeah. I did cover to cover, and my eyes were bleeding after that. That thing, you could kill someone with that book. If, we're on the 3rd story in our building, and if someone was walking right down the street, I could drop Common Stocks and Uncommon Profits on their head, and it would hurt a little bit. The poor Charlie's Almanac, because it's spread out, it would hurt, but it wouldn't be brutal. Security now, I'd be wanted for murder if I dropped that from a building.
Yeah. Well, remember he wrote that in 1934, 3 years after the big crash, and it was all about numbers. It was all about the facts. Give me the facts, give me the facts, give me the facts. And if I can buy the facts at a discount, I'll play. If I can't buy the facts at a discount, I'm not playing. Yeah. And he overwhelmed people with facts. There's a story that Warren read. So when he read Intelligent Investor in, I think it was June of 1950, after graduating from college, and that turned him on, he immediately applied to go to Columbia to study with Graham and Dodd. He thought they were dead when he was looking them up. He actually found that they were teaching at Columbia. Got accepted, and before he got to Columbia, he had already read Security Analysis and basically had it memorized. And David Dodd taught the fall class of Security Analysis, and he knew every case study. So every time David Dodd would ask a question, Warren raised his hand. I got it. The spring class was more of a seminar class of 20 students that Graham had taught, and that was more about real life examples of stocks currently in the market, how to think about them and stuff like that. But he sopped up that what was it, 400, 500 pages, 600 pages of security analysis, and pretty much had every case study memorized by the time he got to Columbia.
So be honest with our listeners. How much did you actually absorb from that book? Because I absorbed...
Not much.
I mean, I'd be generous at the 20%, because it's dense.
Yeah. Oh, yeah. Well, I mean, given the choice between reading 600, 800 pages of security analysis, or I think I've counted now 952 pages of Warren's shareholder report letters,
yeah.
I'll take the Berkshire letters over security. I mean, at least it's a little bit more fun to read.
Yes.
It's a heavy lift. It
is a heavy lift.
Yeah.
Well, so you obviously said out of the three most influential people in Warren's life when it comes to investing, Charlie would take the cake over the next decade. But if you were coaching new investors on who to emulate to grow their wealth, which one of those three would you point them to?
Well, so I mean, I guess we could say in many ways, I keep coming back to Charlie. One I like about Charlie, and we're going to talk about this in Omaha, kind of the multidiscipline thinker, right? I think to outwit the market today, you can't just be a CFA that understands balance sheets and income statements. There's got to be more to it than that. And when Charlie talks about building a lattice work of mental models and being multidisciplinary in your thinking, he's pulling in the great ideas, from physics and biology and literature and mathematics and philosophy. And when you start to go down that rabbit hole, you certainly do see the light bulb go off more often for you than if you did nothing but just be a CFA and do balance sheets and income statements and go to CFA conferences. I'm not disparaging the CFA. I think it's important. It is part of the credentials that you need to have, but you need to have more than that. And Charlie was this multidisciplined thinker. He reminded me a lot, or I should say Bill Miller reminds me a lot of Charlie Munger. I had the opportunity to work with Bill Miller for about 14 years, and he'd be the walking example of Charlie Munger, a multidisciplined thinker. And here was a guy that was raised on Ben Graham. That's how he started Value Trust. He evolved to Warren Buffett on cash flows. He then, picked up on Al Rappaport's creating shareholder value, which is creating shareholder value occurs when you earn above the cost of capital and you destroy it when you earn below the cost of capital. So he evolved to that. And then he got involved with the Santa Fe Institute in studying complex adaptive systems and new economic thinking and path dependence, lock-in, increasing returns. And he was the first value investor to ever crack the code on technology. So, and he went on to beat the market for 15 years. So when you begin to think about long-term, 10 years from now, you want a flexible thinker. You want a very adaptive thinker. You want a pragmatic thinker. Things will be different 10 years from now than they are right now, and you need someone that basically can continue to evolve and adapt to a changing landscape. And I think Charlie is of that mindset. I mean, Boyd was a home run. Nobody knew anything about BYD. I mean, nobody knew nothing. And, he said, this is going to be a big winner. And, Warren put a little money in it, didn't put a lot, but it was a hell of a lot of money. Costco home run. So you want somebody that's flexible, multidisciplined thinking, can take in new information, can think about it differently. And I think Charlie would be a guy that in my book still would be the best pick of them all.
Yeah, well, and also one thing, too, that I think Bill Miller, obviously you know Bill a lot more than I do. I've never met Bill.
Yeah.
I'd love to meet him, but he definitely got Charlie's humor, too, because he is, I mean, you listen to the guy, and it's just, I don't know. I'm clearly not worth $1 billion. We've got a ways to go there. But I feel like when you crack $1 billion, the amount of, and I'll keep it PG, blanks that you give are pretty slim. Yeah. And it's like, look, I'm just going to say whatever I want to say. Charlie was almost 100. I mean, the wheels had fallen off probably 20 years ago. But I will say, and I'm not going to toot my own horn here, but we've been promoting on our show a lot the whole idea of being dynamic and nimble in the mind when it comes to money. Yeah. And it's different with planning than investing, but it's the same thing. But it doesn't need to be complex. That's the one thing. Kyle Grieve from the Investors Podcast Network came on my show, and also, side note, I didn't realize how jacked and tall the dude is. So when you see him, he's just an Adonis of a man. But afterwards, we spoke for hours about this, how investors today, because with Warren, let's just face it, the dude's old. I mean, he is in extra innings. He's in the bottom of the 14th. Yeah. And it can be challenging for a lot of people to grasp, even with someone that explains things so simplistically like he does in his letters. There is a disconnect with verbiage today. And I wish a lot of people would be able to take, or I wish there would be an investor that could take the verbiage that Charlie Munger had, but instead of being 100, talk like a 30-year-old. And get people to understand that. So I'm not saying I'm the one to do it, because compliance will probably not allow me, but someone that is not as compliantly, regulated as me, have at it. So.
Well, I think, I would say this, Chris, when you're 30 years old, you don't have street cred to talk like Charlie.
Right.
know, you've got to earn those stripes. You've got to have some scars. You've had to have some battles.
What about 32?
You had to live through. Maybe. How about 52?
Okay.
I mean, that's what, one thing about Bill, Bill's in his, young 70s now, but, when he was 50s, he wasn't a gunslinger. He was still minding his manners. But as he got older and more successful and things like that, I think your patience for banality is less. Yeah. And you begin to talk more pointedly and sharply about how to think about things. But, when you're young, you're still pleasant.
Yeah. Well, and I'm just going to say for myself, obviously I don't have those years of experience, but I definitely catch myself talking like Bill and Charlie. So by the time I get to their age, I don't even think I'm going to be allowed on another podcast. I actually wanted to bring something up that I found really interesting. I wanted to pick your brain at it. So Buffett has said that the definition of a great company is one that will be great in 25 to 30 years.
Yep.
I completely agree with this. However, I struggle with this specifically with Berkshire, and I'll tell you why.
Yep.
I'm not saying Berkshire is not going to be a great company, and I'm not giving investment advice for you compliance people out there, but due to just the sheer size of Berkshire, yep. I struggle to see how it can maintain the success that it's had from years past. Yep. So what do you think is going to happen to Berkshire in the next 10 years or so?
Yeah, I'm a little more optimistic about it because of this reason. We're talking about what are we now, $800 billion, $900 billion market cap company heading to $1 trillion. And as he says, to move the needle on that, you need big ideas. A little $10 billion, $20 billion idea, it's 1-2% of the business. It just doesn't move the needle, right? So to do something that's going to move the needle, you need $100 billion ideas, or $200 billion ideas, and that clearly was Apple. I mean, a $35 billion idea that became a $160 billion idea became 20% of the net worth of the company. That's a big idea that had a big impact on a big company. So you see where I'm going with this. It's what other mega cap stocks or mega cap opportunities could you think of Berkshire owning that could move the needle? And so then if you look at the top 5, 10, you think about Microsoft, you think about Amazon, you think about Google, Meta, NVIDIA, you go down the list. The question then becomes, in Warren's mind, because let's go back to your original question, a great company is a great company today that can be a great company 10 to 20 years from now. So a great company today is a company that generates cash, earns above the cost of capital, and let's say they can grow at a low double-digit rate for a long period of time. That's the competitive advantage period. That's what you have to think about. How long can this company do it? What's been shocking to everyone, except those that went to the Santa Fe Institute, was that the bigger companies, which are basically knowledge-based businesses, actually could get bigger, grow faster, and increase their returns on capital. So they became increasing returns businesses the bigger they became, versus the old brick and mortar companies were diminishing returns businesses, which as they got to a certain size, another dollar's worth of investment didn't give them a higher rate of return. They kind of hit the brick wall. But in knowledge-based businesses, particularly in the global marketplace, they can get really big. And the bigger they get, the more the returns are higher, the more leverage they can return because they're low asset businesses. So if you said to me, okay, I've got an $800 billion business, I need $100 billion, $200 billion ideas to move the next needle, I think there are opportunity sets out there. because the companies that actually can do extremely well at a long period of time, competitive advantage period that can last 5-10 years, earning above the cost of capital, generating tons of cash, growing at a decent rate above the rate of the GDP, you've got a pretty good lineup here. Now we can talk about the antitrust, political forces, and things like that. But things are going to be argued about for the next 5-10 years. But could Berkshire one day buy Google? I don't know. A long time I think he couldn't buy Microsoft because of his relationship with Bill Gates on the board, things of that nature. But I always thought that Amazon was a perfect business for him to own. And even he, kind of kicked himself in the butt as errors of omission. I shoulda, coulda, woulda. But they're big cap companies now that still have a lot of lifeblood left in them that could motor something the size of Berkshire. So I'm not as kind of skeptical that Berkshire can't get it done. They just need a couple of more apples in their fortress. But there are Apple-like companies out there that are available. So we'll see either what Warren does or Ted or Todd, the next generation of stock pickers. Ted's very flexible in his thinking. Todd's very flexible in his thinking. 5 years from now, you don't know how those guys will be allocating capital. And I'll say this about Warren. I'll bet you a cup of coffee and even a steak dinner in Omaha that Warren goes a day longer than Charlie. He just likes the competition. If Charlie can live 33 days shy of his 100th birthday, Warren is going to set himself a goal to at least get to 32 days shy of his 100th birthday, because he never likes it when Charlie beats him.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
I know. Well, I will tell you what, I will take you up on that offer, because I will never turn down. Well, a cup of coffee is one thing, but you offer me a steak dinner, I'm done.
Yeah. We got to go to the Rovers there, or go to Gratz or one of those places and have us some hash browns and a Omaha whiskey rub steak. That'll be. I think I
just developed diabetes in that sentence, but I'm not upset about it. Well, and I also want to clarify, I'm not pessimistic about that the Berkshire question that I asked. For me, it just comes down to, it's not even a Berkshire. Like I look at a lot of these companies and go, okay, are they great companies, like these big companies out there? Sure. Are they all right for me to own? No. That's a whole nother story. Yeah. But it's one of those things where there's got to come this point where, because what are we in the game of? When it comes to investing, we're trying to grow our net worth and the game of doubling, right? And sure, he bought Apple with $35 billion. Now it's up to $165. There comes a point where you go, okay, that world becomes so small, and then if there isn't anything else to do, right? Like if nothing works in that world, I guess you could just keep waiting and waiting and waiting, which is also part of his brilliance and patience. But I just feel like size has to come into play, because he's defied physics for 94 years.
Yeah, I see. I know where you're coming from, Chris, and I don't hard disagree with you, but I think when two things are working in your favor. One is that the world market cap is growing in size. So that in itself, we're 72 billion market cap in the world. Probably in the next, 10 years, that'll be, over 100 billion, right? And 125 trillion, excuse
Big
me.
difference.
Or 70 trillion in market cap. Excuse me. Yeah, I'm sorry. You should have
That's
corrected
okay.
me. 70 trillion in market cap. We'll be over $100 trillion in market cap. So you could have these phenomenal businesses that are $1-2 trillion businesses, but are so small relative to the world market cap. There's still a lot of growth. I mean, think about Apple. Apple's barely 3-4% of the world's total market cap. That's not that big. So as the market caps get bigger in the world, the companies that make up the market cap get bigger in the world. As those companies get bigger in market cap, they can have an outside impact on a market cap of Berkshire Hathaway. The only reason why they wouldn't is that if the economic returns of the trillion-dollar businesses begin to generate returns below the benchmark, the market's benchmark, which is basically 10-12% return on capital, 8-9% earnings growth. The metrics, that's your benchmark. So if the big boys can't generate a return better than the benchmark, then it's a problem. But as long as they can, I wouldn't have a problem. I mean, I own, Amazon, Microsoft, I own them. I think they're great companies. I think they can still be great companies. They're big companies now, and those big companies can have an impact on even bigger companies. So I'm more of an optimist about it than a pessimist right now.
Yeah. Well, and you actually teed up this question that I've been dying to ask you. So obviously the best problem a company has, and I'm being facetious here, is when you have a ton of cash and you don't know what to do with it. Okay? And when that happens, generally speaking, companies either pay out dividends or increase it, or they buy back shares. And obviously it's prudent when a share price decreases, the company buys back more of it because then we get proportionally more of the profit. And then when it increases, if we don't have anywhere to go, we pay out a dividend. I'm saying this because as we're speaking, there are these massive businesses that are buying loads of their shares back. And I'm not going to name any specifics, but we're talking at price to earnings ratios in the mid to high 30s, which isn't always the picture. But it's a good starting point. And so what do you think is going through Buffett's mind right now with this?
Well, it's a two-track thing. One is, I think, it's a fortress balance sheet on Berkshire. I mean, he is, that 1-2%, 3% chance that the market could go down 50%, maybe because of a geopolitical crisis, a pandemic, whatever the case may be. There's no chance that Berkshire will have a permanent capital loss. I mean, he's running it for no permanent capital loss. He's said that many times. He feels that obligation to, many of the original shareholders. So yes, he's overly conservative in his balance sheet fortress, but for reasons that are explanatory. You either agree or you don't, you disagree. The thing about multiples, Chris, we got to be careful is that, let's say, and Apple's a little squishy right now because it's flatlining on iPhone sales, even though the App Store is growing like a weed, 30, 32 times earnings. But you can make that Microsoft, 30, 32, 33 times earnings. But when you look at the sales growth and you look at the return on invested capital, if you're earning 50, 60, 70, 80% return on invested capital, and Michael Bobeson has talked about this extensively, do you think you should be trading at a market multiple? The market earns 10 to 12% return on capital. These guys are earning 30, 40, 50, 60, 70, 80% return on capital. Apple over 100% return on capital. Even if it's growing at the same rate of market, and they're not, they shouldn't be selling at a market multiple. They could be selling at 60, 70, 80 times earnings and still not be overvalued because nobody takes into consideration how to how to control for return on capital. Two companies that grow at the same rate, one earns 10% return on capital at a 20 multiple, another one earns 40% return on capital, should not trade at the same multiple. So it would not be outrageous that a company could trade 30, 40 times earnings with a 50 to 100% return on capital and be considered undervalued. Michael Mauboussin, as I said, he's right up there with the best, has pointed this out extensively. So we can't get hung up on multiples. They're nothing more than the market's, kind of expectations. High multiple stocks, the market loves them. Low expectation stocks, the market hates them. as Buffett says, polling doesn't replace thinking. You don't know whether they're overvalued or undervalued until you actually do the work. So, when I think about multiples, I look at a multiple and I go, yeah, that's higher than the market, but let's go see if it's justified or not. And when I look at the cash conversion cycle, I look at earning nearly triple-digit returns on invested capital. I go, yeah, it's worth every penny of it. I mean, Amazon's been a 40 to 50 to 60 to 70 multiple stock since, 2005.
Right.
It grew into $1 to $2 trillion business. So multiples don't tell me a whole lot until I look at everything else.
I get that, and I totally agree with that. Well, and okay, so you got the outliers like the Amazon, like the big companies that have always been at a high P to E ratio, but like Phil Fisher would say, they've earned it. Okay.
Yeah.
I wouldn't say all companies are like that. And that's where it's getting crazy, because I've seen a lot of these businesses out there where they are buying back more of the company at, and you could say 30s to 40s, right? Phil Fisher and all that. I think that goes out the windows when you're in PEs of 80s and 90s and hundreds. Well, and so, my thing is, how egregious do you think a lot of these companies out there are just spending unnecessarily? Because I would imagine, not in Berkshire, but companies not invested within Berkshire, Warren is scratching his head at a lot of these managers, don't you think?
Well, it all comes down to the manager that says he's buying back stock, whether it's a mega cap stock or whatever, has I think a duty, an obligation to tell his owners, we're going to take this money and buy back our stock because we believe our stock is undervalued by X, based upon what? We value, and Warren has kind of gave you the breadcrumbs for you to go figure it out. But there's many different ways that people can make the clay and figure out what it's worth. But he's not telling you any one way, but he should give you information for you to come up with your own determination of what an approximate value is. And in doing that, you then should be able to go, yeah, it makes sense to buy back the stock, or no, this is ludicrous. Why would anybody buy back the stock when the price is significantly higher than value? So I get it when people are buying back stock left and right, but that's up to management, I think, to at least enlighten shareholders that this is a rational way in which to allocate capital. I mean, Apple has bought back nearly half of its stock in the last 10 years. Well, that wasn't a bad bet. I mean, considering where the stock was when they began and where the stock price is today, that seems to me that the stock price was undervalued. Had they allocated that much capital to an overvalued stock, market cap wouldn't be where it is. So I think the role of management is to give the owners of the company some insight that this is just as they would, if I went to buy a business, I would say the reason why I'm spending $100 billion on this business, guys, is because I think it will add value. It's going to add value because of X, Y, Z. If you say I'm going to spend $100 billion on our own business buying back stock, I think this is going to increase our value because of X, Y, and Z. I think that has to be part of the pudding.
No, that makes total sense. Well, and you've mentioned that Buffett has spoke about John Burr Williams' book a lot, okay? The theory of investment value, for those that are listening that are not aware. And it lays out the discounted cash flow method. So I've interviewed a lot of investors. I've gotten to go on a lot of these shows. You're a much smarter guy than I am, Robert. We all know that, okay? And better looking, okay?
No.
And so, the more I get to interview a lot of these people, though, my mind has started to churn around the discounted cash flow method. I'm not saying it's not valuable, but I get a sense that it's more toward the academic side of investing and less toward the practicality. But I'm not saying it's not practical. So what is your take on like the discounted cash flow method? Like, do you use that pretty regularly, or do you use a lot of the shorthand strategies out there as well as the qualitative questions?
Yeah, all of it. I mean, we do use dividend discount models, and we think that's a good way in which to think about once again, we're talking about the approximate value, not the precise value. And I'll look. So, in the book, I think we use the Gordon model, the two-stage model, and we ran the numbers out 10 years at an above average rate, and the residual growth rate in year 11 would default to the sustainable growth rate of the economy. I've run models 3, 5, and 7 and 10 years. I've changed the assumptions. get a matrix of possibilities to get a weighted average. I've looked at, back of the envelope, what's just the free cash operating yield of the market, of the business right now relative to the bond market. You're building a matrix of assumptions to get to an approximation, and the approximation can be wide. It can be a wide cone of different values. The trick is, are you buying the cone at a discount? Yes, no. And if you can buy the cone at a reasonably discount, then whether it's worth this or it's worth significantly higher than that, as long as you're buying the cone of uncertainty at a discount, you're pretty good to go. Now, this is something we haven't talked about, but I continue to think about it. Warren says that all the mistakes that he's made in investing, it wasn't because he overpaid for the stock. It wasn't because he signed up with bad management, and exceptions here and there. But it was because he misjudged the competitive advantage period, which you could argue is that they overpaid because the competitive advantage period didn't last as long as he thought it would. But most of the time, the mistakes that you'll make investing is that which you think will continue to earn high returns on invested capital doesn't last anywhere near as long as you thought it was, or thought it would be. And so what I'm always looking at in my portfolio is I know what I own, I know why I own it, I know what the economic returns of what I own, and they're mouth-watering. I'm looking around trying to figure out who's going to take my business. Who wants my business, who's coming after me, and I'm trying to figure out who can take away my competitive advantage period. That's the moat, that Warren talks about. So Amazon has done a great job in taking business away from a lot of people because they'll operate on razor-thin margins. That tiny margin is my profit, and I can take you out with that. I'm always looking for an Amazon that's coming after me. And I spend more time worried about that than I do about the market, what's this quarter's earnings, what is this quarter's sales. I'm just trying to figure out how long can we keep compounding, because a great company is one that can compound at above average rates of return of capital for a long period of time. Once you do that, where you bought it, T minus 10, becomes less of a big problem. The challenge is how long can I keep it going? And the longer you can keep it going, not only the amount of money you make is going to be huge, but the precision of where you bought it day one becomes less relevant to the whole calculation. So for me, it is how long can we stay in the game, earning above the cost of capital.
And maybe it's just so on one of the shows that I went on, they were asking like how I value businesses and all of that, and maybe you can critique me on my own show. I actually welcome that, okay? But be careful, because I'm incredibly sensitive. So, for us, like, I'll just take my business as an example. So we'll probably hit the $1 million revenue range this year, and our business as far as thank you, yeah,
congrats, yeah.
And so, in advising, margins can be good, all that fun stuff, right? So let's say margins are 50%, whatever the case may be. So looking at that, in our industry right now, at a revenue of $1 million, multiples at revenue are probably 2, maybe 3 times. And then you could do profit at higher, but let's just keep it really easy, right? So if someone comes in and goes, hey, right, you'll buy it at like 2 to 3 million. I'm not selling. Okay, I've got a 14-month-old. She's extremely expensive. I'm going to be doing this for a long, long, long time. But just hypothetically, if someone says, hey, 2, maybe 3 million, right, there's like that art of the deal, because they would come in and buy it at maybe a higher rate. And I would go, okay, like that's a reasonable selling point, right? Everyone wins, and they can find efficiencies and all that. They won't be as entertaining, but that's beside the point. If they come in and offer me $500,000 in revenue, I'm going to tell them to pound sand. Like, that's silly. But then if someone comes in and says, hey, Chris, we're going to buy Capitalize Your Finances for $20 million, you've heard it here first. Every single client's going to have to find a new advisor, because that's an egregious, like, how would I not take that? And so for me, it gets to be super difficult when you apply that mentality to the public markets, because then you see these multiples that are so high. And so I'm asking you this, and I've got teams that I, of course, trust and work with, and obviously I get it a lot more than maybe I'm alluding, but how would you get a common investor to expand their mind where they're not thinking of these small multiples? Because the public markets, that's just not the same.
Well, when the market's selling 2, 3, 4 times sales, right, it's because the average economics of the market are such that it's growing at 8, 9, 10% a year with 10% return on invested capital, and the margins aren't that high, and blah blah blah. So you get to 2, 3, 4 times sales. But as I said, if you're earning 100%, 50% return on capital, you have 70% margins, you're going to trade at a much higher multiple of sales as you would a multiple, so it makes sense. So all of them are you need to look at them individually. Just because the market's 3, 4, 5 times sales and somebody offers you 10 times sales doesn't mean that they've lost their mind. They must see some economics in there that make it worth paying the number that is 10 times sales for them to generate a return on that number that would make it worthwhile to pay. So, yeah, there's some crazy multiples out there, and some of them are overvalued and some of them are not. And the trick to investing is trying to figure that out. I think Ben Graham said at the height of the market in the 1950s, when he finally shut down, his Graham Newman hedge fund, and he was asked to testify before Congress because the Dow Jones had reached its highest level since the 1929 stock market crash. And they said, do you think the market's high? And he goes, yeah, the market is high. And there are some stocks that are high, but not all stocks are high. And that question is trying to figure out which ones are not high and which ones are, and avoid the ones that are high, and try to invest in the ones that aren't. And so, one of the presentations I'm going to do for Charlie Munger tribute is beware of averages. We have a tendency to look at averages as being some explanatory force. Well, it's just an explanatory force of all the variations of the market, the average of all the variations. We think in averages, but we don't think in variations, said Stephen Jay Gould. You need to think in the tails, and there's some tails that are worth a lot of money, and there's some tails on the other side that are like disasters. And then you look at the average and go, well, if you're paying above average for something, it must be stupid. Well, you don't know. Once again, polling does not replace thinking. Figure it out. If something is an aberration, a variation, figure out whether it is a smart one or a dumb one, and then act accordingly. So be careful of averages. They can be highly misleading.
So what Robert's trying to say is he is willing to pay $40 million for Capitalize Your Finances today. That's basically what I'm getting at.
Let me see the book. Let me see the books, Chris. Open up the books. I'll tell you.
I appreciate that, and that I think, that definitely helps me. But that's for sure going to help a lot of our listeners. And Robert, look, I really appreciate you coming on the show again. It's been a long overdue 2 years. I can't speak for everyone, but I've missed you dearly. I wanted to ask you, how is Warren feeling about this upcoming Berkshire event? What's on his mind since the last time you spoke with him?
Yeah. I did not speak with him shortly after Charlie's passing. And when Warren and I chat, it's only by emails. I very rarely, if ever, will call him on the phone. It has to be red lights blinking and danger, danger, Will Watson, which I haven't had that happen. But we exchanged emails, and when I told him about the new book coming out, he was very pleased. He was glad, because now as a Wiley Investment Classic, it stays in print for the next 30 to 40 years. And that was important for him, that this book would be read by somebody 20, 30 years from now in the library, hopefully having an impact on how they think about investing. And when you become a Wiley Investment Classics book, they do keep them in print. So that was the great news for Warren. He was very happy about that, but he did talk about Charlie. He said, it's going to be very Charlie-centric this year. It can't be anything other than that. So I expect, the movie prior to the meeting, a lot of things that go on during the meeting are going to be very, very Charlie-centric. Not morose, he said, but out of respect and remembrance of all the contributions that he had made to Berkshire, to Warren, and stuff like that. This will be a year to celebrate Charlie. And it won't be a sad occasion. I think it'll be a celebration. I think Charlie would be mad and disappointed if we were downtrodden. He would say, you guys can do better than that. Take the best of what I am and what I've left with you and go on. That's what Charlie would want, and I'm sure that's what Warren will do as well. So I'm looking forward to the meeting. It will be a moment when you pause and say, Charlie's not on the stage, but he will always be with us. And our duty is to continue to behave in the rational way in which he helped us learn about investing, and that's our job.
Well, and you never know, right? I mean, they may do a spoiler alert saying, we're wheeling him out one more time, right? And actually, Charlie would laugh at that. He would laugh at that.
Yeah.
Well, Robert, so. where can our listeners go to snag a copy of The Warren Buffett Way and, of course, support you?
Okay, well, the book, the official pub date's April 23rd. It's, you can pre-order Amazon. It will be in the bookstores on April 23rd. It will be out in Omaha. It will be at the bookstores there. It'll be in the bookstores across the country. But Amazon, April 23rd, you can pre-order. It is a compendium of everything that I've written for the last 30 years. Going back to Warren Buffett Way, going to the Warren Buffett Portfolio, going to the Ultimate Money Mind. We took the best of everything that I've got and updated it, not only about Charlie, we updated it on Apple. And one person we left out, which would be well worth reading, is the influence of his dad, Howard Homan Buffett, which we did talk about in the Ultimate Money Mind, but we brought it back into the Warren Buffett Way as being a big intellectual influence. So there's a lot of new material here, but very proud of the book, and as I'm repeating myself, I'm more proud that my grandchildren one day might see that their grandfather still has a book that's in print in the library there outside of Philadelphia, and that is, I would say, is an ultimate testament to Warren Buffett, long-lasting.
Yeah, well, Robert, thank you so much for coming on, and I cannot wait to see you in Omaha. And by the time this comes out, this is going to come out right before the event. So for those of you that are still listening in, if you're going to the Berkshire event, I look forward to seeing you there. And as always, Robert, keep capitalizing, man.
Great, Chris. Thanks so much for having me. I'll see you in Omaha.
As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Paniotu, Certified Financial Planning Professional, the Cap and Capitalize, and until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Christopher A. Paniotu is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Robert Hagstrom is not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.